So disclaimer, your trades are your own. So I think that we've seen some behavior that's important to kind of analyze in the market. And that is, we've seen whenever there's positive economic reports, the market is kind of weak. And when we get basically really weak reports, like the ISM, the PMI, the ADP, and jobs growth, then the market can behave a little bit differently. And so you want to what's really happening is it's this bad is good is bad phenomenon. And the reason that's the case is because the market is really trying to figure out, are we heading for a soft landing? Or are we heading for a recession? How much more is the Fed going to have to tighten? And so we have the market right now is discounted a couple 50 basis point hikes and then kind of tapering off and cutting down the pace of hiking and slowing going into the election, really. And so if there's strong economic data, it means the Fed can hike more without problem, and that's negative for the market. The thing that is important about that is that usually when you end a major correction, you kind of have something that looks like it might be resolving the problem that created the correction in the first place. So we really, the correction started on inflation and increased pace of rate hikes. And so if we don't get that more resolved, it's not going to allow the market to rally on a sustainable basis. So that's really something we have to watch. The March correction was basically 19 days, and then it fell back into the range on 80% down volume. That's the last bear rally we've had. So we need to kind of watch the 19-day period. We need to kind of watch prior resistance levels and watch things and just see how the market is performing on an internal basis. We've had some good. We had an intermediate term correction over signal, but it's kind of tentative because we have some concerns. And right now, they're not fully being alleviated. We're slowly getting more thrusts. When we get, 3-4 more, we're going to be in the range where, most sustainable bottoms have that kind of number of thrusts. We're not quite there yet, but we've had more. But we're seeing the rally is on lower volume. We haven't really had good volume traction yet. And we'll talk about it, but it looks like a lot of this sectoral behavior and stuff is not really consistent yet with a sustained bottom. Now, you can get a correction over in a long trading range, and eventually things will kick into gear, and it'll start to gain more traction. That's possible too, but it's also possible this is another bear rally, and we need to really be watching for a lot of those things. We can see that the S&P bounced up to we have sort of an HVN at the prior lows. And we tried to break through it a little bit on, Thursday, and then Friday came back down. And the rally on Thursday was an 80% up volume day. And it was also a big spread day, so it did add another thrust to our count. But it was predicated on that ADP coming out and people anticipating, okay, non-farm payroll is going to come out and show weakness. We've seen in that FOMC meeting minutes, had a number of Fed officials that said, well, I want to tighten and I want to be hawkish on inflation, but we still have 5 million jobs that we had before 2019 are not there anymore. A lot of those people have dropped off the labor force, so it's not really counted in the official unemployment rate, but even the official unemployment rate still has 1 million people not getting jobs back. So the Fed there are dovish members of the Fed that would like to see not really kill the recovery when we haven't even gotten all the jobs back. And so when we had looked like the ADP report came out, it looked like it was going to be weaker, and that's going to put the Fed on more hold and give those dovish Fed officials a little bit more room. but then the NFP report came out and it was pretty strong. And so what that means is the Fed has a green light to continue tightening more beyond the 250 BP hikes that are anticipated. And so when you see that type of behavior with the market reacting that strongly, what you know is that the narrative is in flux. The narrative is trying to figure out how much hike are we going to get, and is it going to lead to really weaker economic growth and maybe recession, or are we just talking soft landing? That's really what the market is trying to figure out. And you can see the job growth, basically, the good rule of thumb to remember is as long as there's jobs growth, there is no recession, right? We have this indicator that we use in our checklist for a bull market top or a bear market bottom, and one of them is that unemployment ticks up above this 20 monthly EMA, and we're not anywhere close to that. We're still moving down in unemployment. That's not really a recession. So we don't have a recession. We had 1 quarter of negative growth, but we don't. It looks like the second quarter is going to be positive. That's going to interrupt that. We'll get to that. And we don't have some of the warnings. Some warnings that you can watch are for the 210 yield curve to rise and close over 0.5. Usually the yield curve drops, goes inverted, and actually the recession doesn't start until the yield curve starts to go above 5. We haven't done that yet. Unemployment rate's not rising above its 20-month EMA. Copper's not closing below that handle range of 4. So those are things that we can watch. If 2 of those happen, we start to get a lot more nervous about recession. The Fed's GDP now basically has been fluctuating in between 1.5 and 2.5. And with this much of the quarter done, it would be very extreme. You have to have some real shift of major, developments to get GDP negative, which means we're not going to have an official recession in Q2. And the other thing we realize, there's a lot of these things that the Fed does, there's a lot that others do. They're getting up to these probability of recession forecasts that look at a lot of macro indicators. They're getting up to levels of soft landings in the past. They're not getting up past that into real recession straight ahead mode. And then the other thing to realize that's kind of negative, and the reason the market's a little bit nervous about non-farm payrolls and other things, is that now we have a plurality of firms starting to raise wages. We have all these job openings, but people aren't taking them. And so what they're going to have to do is, so more and more firms are saying, okay, I really actually do need this person. They're going to be raising wage rates, and that is very dangerous from the Fed's perspective, because with the times that you get this sort of inflationary spiral that then takes enormous tightening to overcome is when you get a wage price spiral. Higher prices lead to higher wages, and then back and forth. And so there's a number of hawks now that are starting to talk about that, and that's going to be a real problem. It's going to prevent the Fed from softening up too much. And let's see, the other thing to realize that we've talked about many times, continues to be the case. Here's the Fed funds rate in black, and here's our neutral rate, the 2-year market rate. I love this chart. It tells you a lot of things. One thing it tells you consistently since World War II is that markets would do a lot better job setting interest rates than a committee of economic DHDs has done. Virtually every time there's a recession, the Fed cuts rates below the market rate by a substantial amount. The market rate begins to creep higher. The Fed funds doesn't. And then eventually something happens. Either it's inflation or economic growth, or there's some kind of signal of overheating and problem. And the Fed realizes, oh my gosh, I wish I'd paid attention to the market rate, and it has to play catch up. And that's where that happens every single recovery. And eventually it has to pay catch up to the point that it raises Fed funds above the market rate. And that's when we get recessions. So here we are. We've had really chronically delayed Fed reaction. The market rate really took off. It's up here at 2.7. or something like that. And here we are with the Fed funds still, even after this recent rate hike, between 1 and 0.75. And what that means is the Fed is still more behind the neutral rate than any recovery since World War II. So there's likely going to have to be some catch up. Yeah, you might add 25 basis points to this for QT. So that's going to be there. You want to realize that. But probably, even though it's an economy that has way, way too much leverage in it, so it's going to be much more sensitive to higher rates than ever before. Probably we're like, look, inflation, the official inflation is somewhere between 4.5 and 7. The real inflation rate is probably much higher than that. So they've got to raise rates a lot more than just 1.52% to really get ahead of inflation, especially if wages start to move. And the other thing to realize is that, okay, as I've said, when we get 50 basis points hikes, the market usually is sideways. And a lot of times when the Fed begins to tighten, if the market kind of stalls or turns down, it really doesn't turn sustainably higher until Fed funds start to come down. We've already come down in the market when we barely started tightening because the market had been tightening for a long time. And so this is likely to provide some headwinds for stocks. You want to realize, normally the Fed has to hike rates until there's some kind of a riot point. In other words, they get a major bankruptcy, or they get stocks declining more than 20%, or they get the economy weakening enough that they start getting scared to death about recession more than inflation. We're not anywhere close to that, so there could be further headwinds. And then realize that 8 of the last 9 times the Fed raised rates to fight inflation, at some point ahead, recession followed. That doesn't mean it's going to be this year, might be next year, but the odds of recession are growing beyond the near term. Other things that you want to realize, this is a really nice chart by McClellan, and it basically shows this is M2 divided by GDP. So how much is money growing more than actual productivity? And when you get real bit, and this is also shifted forward a year, because basically you get the money supply increase, and about a year later stock prices begin to reflect that. And you can see how well this has worked. You get the big increase before this big rise, this huge rise. This is the biggest rise in money supply versus GDP in history. And we got this big market response, but now we've turned sideways. And so it's going to be some headwinds for stocks. And then realize the last time we instituted QT right here, that's when we started to get problems in 2018 and eventually had a big correction. So there's policy headwinds to stocks overall. We could be in an environment where we're kind of sideways a little bit off the intermediate term correction, possibility low, and there's some sectors that are doing well, but we need those sectors to really grow, and they're not growing much yet. Okay, realize that for inflation in PSL, for example, we have a lot of different strategies that really can benefit you and are helping out our overall portfolio. And you want to be, the aggressive commodities is one that's done super well. It's up 8 something this year, and it's done really well both in recession and inflation periods. So it's a good one for diversification at this point in time if you don't already have that you're not using that in your portfolio. And basically it's been up 17 of 18 years. It's up 806% in the last 18 years on an 18% maximum drawdown.